Howdy, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we'd come to you today with a little bit of a market update. I will confess, I kind of jinxed myself a little bit because the last one of these that we recorded, I told you that I probably wouldn't see you again until 2025. And then yesterday happened. And so here we are back in the studio because I just want to explain yesterday's sort of Fed decision. So Fed came out, cut rates by about 25 basis points yesterday, which was widely expected, but then gave a message for sort of guidance for 2025 that was rather hawkish on the inflation side. And the major indices sold off about 3% yesterday, down to about 58, 80 on the S&P 500. Of course, anytime the market moves that much, CNBC and Fox Business and all of those guys had a field day with the information. I saw a bunch of headlines out there that were, it's the worst Fed day since 2001. I even saw one headline that said that, some combination of trading days for the Dows was the worst since 1975. I just like to remind everybody, as an aside, that it is the business of these companies to scare you. That is how they generate revenue in a nutshell. And just to put things in context, the S&P 500 is still up about 26% for the year, a little over that, including dividends. And the market, even after yesterday's sell-off, is back to where it was on November 18th, which is right about a month ago, almost on the dot. So not quite the catastrophic result that you might have seen in the media. Let's focus on exactly what happened, why, and what was said. The Fed cut 25 basis points. That's been about 100 basis points year to date in terms of interest rate cuts. But they basically came out and said, hey, we don't know about the future path of interest rates in 2025 because we're a little bit on this teeter-totter between unemployment and inflation. As a reminder, the Fed has a dual mandate, right? I'm supposed to keep inflation low. I'm supposed to keep unemployment low on the other side, and we kind of gauge the trade-off between those two. And if you look at those two metrics right now, we'll start with unemployment. Unemployment has been remarkably stubbornly stable right at the sort of 4.2% mark. We reached that mark in June. It has been stable there for many months. And so that's a shade higher than the sort of 4% target that the Fed kind of thinks about, but it's not really moving higher. And so there's not really that much of an impetus for the Fed to cut rates. If anything, if you want to look a little bit deeper into the labor market, wage growth is actually quite strong right now. So I don't think anybody would look at the state of the job market and be like, oh, there's a problem there that we really immediately need to fix. And if you're curious why I would say that, go out and try and hire somebody. It's not as easy as you might think. Meanwhile, on the inflation side, if you look at the path of that data, in May, June, July of this year, we got down to this sort of 0.2, 0.1% month-on-month number in core inflation. And, the right way to think about this is that, 0.2 month-over-month increase in inflation, if I multiply that by 12, that gets you to about 2.4%. And that's right about the magic number that the Fed feels it needs to be at, somewhere between 0.1 and 0.2% increases in prices on a monthly basis, gets you around that 2% Fed target that they're always sort of targeting. And I think those 3 months in the middle of the year where we saw that 0.2, 0.1% range was enough to sort of convince the Fed that the fight against inflation was mostly won. And that, I think, gave them a lot of confidence in their move to sort of start cutting rates. And then, sort of ever since then, inflation has been stubbornly at this 0.3% month-over-month number. And if you multiply 0.3 by 12, you get 3.6, which is decidedly higher than the Fed's target of sort of 2.5. And so the Fed is kind of looking at this inflation picture over here and saying, were a little bit higher than what I'd like to see. And meanwhile, looking at the employment market over here and saying, this doesn't seem like it's that much of a problem, and has come out and said, I don't really see the need to cut anytime soon until we're confident that this inflation number on this side is actually starting to move back down to target. And you know what? Markets don't like that because markets like interest rate cuts. And so you saw a very sharp negative reaction yesterday. You've seen the 10-year Treasury actually rally up to about 4.6%. It was at about 4.2% 2 weeks ago. So about a 40 basis point interest rate rise, 0.4% interest rate rise on the long end of the curve, as the Fed has sort of said, hey, we may need to be at this sort of higher interest rate environment for longer until we're convinced that that inflation target is under control. And candidly, as an armchair economist, they're not wrong in that decision. Inflation is a little bit like a snowball. The faster it gets moving and the larger it gets, the harder it is to stop. Seeing this number that's been stubbornly high at 0.3%, I think the Fed is very clearly indicating, look, I need to see that number get back down to sort of the 0.1, 0.2% land, particularly since unemployment doesn't seem to be a problem. It seems like the economy is handling this sort of higher interest rate just fine from an unemployment standpoint. Let's see if before we turn down the heat anymore, we can just kind of get that inflation number to come down a little bit. So that was the message out of the Fed yesterday. The market reacting very negatively yesterday. Today, a little bit of a bounce, a little bit stable, and that's reflective of the fact that the underlying economy is quite strong. This isn't a panic maneuver. This is an adjustment in the expectation of forward interest rates, which affects valuations and maybe a little bit of growth assumptions. But I would just keep in mind that, the Fed looking at people and saying, the economy might be a little stronger than we thought it was. Maybe it doesn't need the rate cuts to stimulate it, is in and of itself not a bad thing to say. I would just take away from yesterday, it's a little bit of an adjustment. It's not a reason to run for the exits in any way, shape, or form. And hopefully, the combination of the move a little bit higher in the 10-year rate, as well as lower expectations or higher expectations for short-term rates going forward, is enough to kind of cool off the economy and get that inflation rate down to where we'd like it to be. With that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a wonderful day, and I sincerely hope that I do not talk to you guys again until after the new year. Thanks.